All right, guys. Okay. Today. All right, 1 second, you guys. Ooh. All right. People. Okay. All right, Aiden. Welcome. What a day today. That's a good expression there. Excuse me. I still have some nasal congestion here, so forgive me for that. Anyway, hold on. Give me 1 second. Let me kind of get some drink here, and I'll be right back.
Not what? Not permitted under the law.
You're fired. Get the hell out of here. Get out of here.
All right. Today is Thursday, November 7th, also known as Powell versus Trump, and I cannot wait for that to happen. You want to talk about inflation? Watch out the inflation in popcorn prices. That's what you want to invest in right now. But let's begin one step at a time. The Federal Reserve cutting rates by 1/4 percentage points. But of course, we knew that this is going to be a nothing burger meeting. The market was already expecting a 25 basis points to be cut, even though it is a mistake. The surprise would have been if had he paused, but there was political risk with that. That now that we have a Republican administration, why would you pause when you've done 50 basis points before the elections with a Democrat? So again,
Okay, sorry. As we see, the rate cut is it today? I forgot. Like didn't even keep up with the market today, you guys. So been kind of under the weather still. Hello, Kara. Thank you. But anyway, so I might end a little bit earlier. Who knows? We'll see. I'll talk until my my nose fall off. Then we'll end there. Okay. And I do apologize for the voice too. Anyway, so let's talk about the price action today. Obviously, we held up pretty well. While the market is like red, everybody was freaking out, panic everywhere, right? The DXY is coming down, you guys. What else? Gold went up like crazy. The VIX, I'm sure. Let me see how high is it today. It's kind of perked back up again, right? Again, fear in the market, right? A lot of uncertainty, a lot of looking around everywhere, seeing what people are doing. But again, as I expected, I feel like GME is immune to all of that. Okay. Not to say that, yes, if the SPY were to immediately went down by 25%, obviously we're going to come down with it as well. But I don't think we're going to be like 25%. If anything, if there's panicking in the street, right, I'm sure they would do their best to scare people off too, to try to mimic the market for a little bit. But you think it's going to come down here? Huh. We're trading pretty well, you guys, pretty well. But anyway, so we didn't see any tweet from Rowan Kitty for sure. We were expecting it yesterday, obviously. But today was encouraging. Like I said, the price point is pretty flat, to say the least. And if you look at the hourly over here, it seems like it comes down with the market, but then when the market come back up, it's doing that, like straight up. So within the last hour of trading, you see 4 or 5% right there. 4%, close to 4%. If you see from the bottom, let me just measure from the bottom. There we go, 4%. So what is going on? The market is pretty unsure at the moment. If you look at the bond market, just like the video was saying, it's the battle between Trump and Jerome Powell, right? Whether he's gonna lower the rates and all that stuff, but the market is not cooperating. The bond market in and of itself is calling the bluff. So, meaning that anytime they cut the rate, the bond market goes higher. So it's crazy in that sense, like meaning that the market is not agreeing with Jerome Powell, because when you cut rates, usually that's when you are worried about deflation. Okay, not in the inflationary inflationary opinion or direction or whatever, right? Now, the market in and of itself, the bond market, they're pricing in inflation rather than deflation. So that's what the market is telling us about what is to come. Because again, the tariffs and trade war and all that stuff, and the fact that the Jerome Powell kind of cut the rates during the Biden administration for 50 basis point instead of 2.5 basis point. And so it kind of like, make the inflation kind of stickier than it should be. And so again, that's why Trump was like, hey, you're always late to the game, like whenever you want to cut. But, had they been worried about the inflation for a longer time period, remember it went for 2 years, he's been saying, oh, it's transitory, we're not going to raise the rate. That's bullshit, right? And so now when he's supposed to be lower the rate, the damage is already done. Okay, so now even if he lower the rate, it doesn't mean that the market just going to be like, oh, I'll prosper. No. The fear is already entering the market. So technically it's too late already. Now, this is also a good time. That's why, again, cash is king. Any company that has cash to buy, at the bottom, this is why, GME is so enticing, and people should be at least looking at it for the time being, obviously, because we have cash. Okay. Now, I know cash eroded in an inflationary standpoint. I get that. But it's not going to inflate away that quickly. So, the inflation is projected ahead of time. Okay. But immediately, you're going to see that people are fearful in the market, and they're less likely to be like, want to stick around. Even bonds, like the flight to safety, right? It's not, nobody even want to touch bonds right now, because again, like long-term bonds, right? If you lock it in, you don't get to, you probably have a little bit more high rate, right? Like over 4% APY. You can. But that 4% you have to lock in for 20 years. So even that is kind of risky for people, so that's why they want more rates, like higher rates, so that they're completely okay locking in money there for 20 years, right? Now, it doesn't mean that you're going to lock it in for 20 years. If you buy TLT, you could sell it to somebody else who need it at that price or at that point in time. And so depends on the value of the bond that you're buying into, right? So each bond is priced in, like right now it's $86 a share of this particular bond ETF. Um, and so later on, somebody else might want to buy it at $90 because, people are like, well, the rate is not going to be higher than this, even though it's 4%, 3%, 5%, right? But anyway, so now bond has I think, a competition because now Bitcoin is a flight to safety. It acts like it. Because right now I feel like Bitcoin has been matured enough for people to know what it is, okay? And so it's generational for sure. I know people are still think of it as a risk asset, or they want you to believe that. But it's been around, you guys. It's been around for 20 years. It's not going to go anywhere. And now we have a new SEC chairman just sworn in today. And so again, with that, we have a lot to look forward to. But that doesn't mean there's no pain coming. So just prepare for the pain. As long as you have the job, as long as you have the emergency fund, all of that is going to be needed. Okay? And then, yes, if you have an investment, just sit tight. Hopefully you get the right thing, right? Not the Magnificent Seven. Because those going to take a hit the most. And so, yeah, Bitcoin went up a little bit there, but not by much, you guys. So I think, again, it's following the M2 money supply. Let me try to look at it one more time. I think I saw somebody had a video on it. Let me see. Did I buy? Oh, okay. 3 people. 3 people watching. What's happening? I can't breathe, you guys. I cannot breathe. Okay, one second. Okay, let me just play this video here while I'm looking at something.
Bond market that is worth listening to, and the reporters did ask some of these questions. Of course, everybody's going to talk about Powell's answers. Trump is going to fire you. What are you going to do? And he says, no, I'm not going to resign. If he asks me to resign, I'm not going to. Tough guy Powell, right? I'm not going to resign and not permitted under the law. Why are we heading to this inevitable war between Powell and Trump? Let's begin with listening to his answer to why do you think bond yields are going higher.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates, and is that are rising deficits a concern to you?
So we don't comment on fiscal policy, and again, I don't have a lot more to say on what's driving bond yields.
So in a nutshell, he doesn't know why yet. He's dismissive that this could be just a temporary way how the bond market is reacting and trading at. And he's looking for more patterns and all of that. So his response is, I don't know, and he's dismissive of the message by the bond market. This is a huge red flag. And more than that, he thinks that bond yields are going higher because growth in the economy is expected to go higher. But in reality, and Powell knows that, and the reporters know it too. That's why they asked about it, including Leisman. We're going to look at that in a minute. But the reason why bond yields are going higher is higher inflation expectations. Now, Powell says that inflation is going down to the 2% target. And folks will be dismissive that we're not seeing any inflation in commodities, at least not right now. And the CPI is closer to the Fed's target of 2%, yada, yada, yada. But we go back to the conversation that we've done last week, the analysis by Jim Bianco, who said the moment we've seen the odds of Trump winning the elections, we've seen bond yields moving higher. And to be honest with you, bond yields began moving higher the moment Powell began cutting rates. But they've accelerated, that's the keyword, accelerated the pace when Trump took over the polls. Why? The message by the bond market is simple. The Fed cutting rates by 50 basis points is overdoing it, and we will see higher inflation to come. On top of that, the election of Trump, who's promising a trade war and more tariffs, and most importantly, more tax cuts, that's going to add to the deficit and increase inflation higher. This is why bond yields have been heading higher. Now listen to Powell's response to Steve Leisman bringing up this point. Take a look.
In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outline. So we'd start to model it. And then we'd wait. And then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that. And then the law actually passes. And, you'd start to put it, you'd probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model. along with a million other things. So, we have a very large economy. Many things are affecting it at any given time. And, a law change of some kind would go in there, but it would go in. But it would, it's a process that takes some time. Clearly, the legislative process takes a lot of time. And, of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And, the overall effect on the economy at a given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration, constantly. And this will be no different. But, right now there's nothing to model right now. It's such an early stage. We don't know what the policies are. And once we know what they are, we won't have a sense of, when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now. And all that will take time. And it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against in that they go against the direction of policy by adding restrictions to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions only to find, 3 weeks later the 10-year was 50 basis points lower. So, it's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
The problem with his response that, when yields went to 5%, people were drawing conclusions, all of that. No. Back then, yields were going higher based on expectations about your policy. And then you paused because of the banking collapse in regional banks. At the SVB episode on that. Yields went down after that happened, because you paused interest rate hikes and you promised cuts to remedy the crisis in the banking sector. The difference here is the way bond yields are rising is different than before. It's not rising because of expectations of the Fed hiking rates. It is rising because of inflation expectations moving higher because of certain factors, among them the Fed easing when they shouldn't. You don't ease when the stock market is all-time highs. By 50 basis points, by the way. And on top of that, you have the trade war, the tariffs. And on top of that, you have another tax cuts that will add to the deficit. All of that is inflationary. That's what the bond market is saying, and it's harder to pull bond yields down because all of these things happened or will happen. Do we think Trump is not going to do the trade war? He's just bluffing? Do we think that Trump is not going to pass another tax cut? If you think that, then okay, maybe the pop in bond yields is just transitory. But this time around, since these things already happened and will happen, it will be harder to pull them back. The most alarming part of his response is that in our models right now, we're not pricing in any tax cuts. So in other words, Powell is saying once the tax cuts are enacted, and we see inflation already in the economy and deficits exploding, then we're going to react. Then we're going to assess the damage. At that time, bond yields might be already making new highs, higher than 22 and 23. What do you think will happen to the equities market at that point? In the short term, of course, we can do the tax cuts optimism and equities will go higher. No doubt about it. But as the deficit explodes, an anticipation of a tighter policy because higher inflation becomes dominant in the bond market, there's going to be a point where the market cannot hold it anymore. You know why? Because the higher rates go in the economy, the more pressure you're going to have against the consumer. And that's going to be reflected in corporate earnings. So we're going to see the market flushing down in a big way because higher bond yields are projecting that the Fed will have to hike rates at some point. And this response by Powell suggests that the Fed will be behind the curve once again. It's 2021 all over again, but now it is more extreme than before.
Oh, okay. Anyway, I don't want to play too much. I've already played too much. But of course, he explained it much better than me. So apparently, the stock market is going to crash, you guys. Okay? It's not like it's going to be rosy. Okay? It's going to be rocket. Okay? I mean, rocky. But like I said, it's okay. It's okay. They're going to print money. They're going to prop the market up again. They're going to have to. Every central banks out there are already lowering the rate and are prepared for bailouts and all that stuff. So I know Jerome Powell said, no, we're not going to bail out the hedge fund and all that stuff. That's bullshit. That's bullshit. They're going to have to. But anyway, so, I mean, they have no other way, you guys. So the only other way is to get out of the system altogether, which is why I think this cycle of Bitcoin is going to be a lot higher, okay? A lot higher because of the flight to safety. And eventually people are going to be like, well, why should I lock in money with the U.S. government with the risk of the U.S. government not being able to pay it back because of the deficit, because of the, low growth, too much debt, all of that. It's really kind of scary to think about. But they're gonna have to print at least $20 trillion to prop this up. So, where do you think that money's gonna go? Huh? What do you think? Huh? So of course it's gonna go. Some of it's gonna go into Bitcoin and gold and all that stuff. So it's a fun time to be in crypto for sure. It's going to be. And so when the stock market goes down, right? You typically see the DXY coming down with it. Hold on, let me see if I could find. Do I even make sense, you guys? I feel like I don't make sense at all. I feel like, what the heck? What was that? Okay, there we go. Okay, so there's an inverse correlation. Okay, correlates here. So this goes down while this goes down. So where is the instant in which that's happened before? I wonder. Right here. Okay. So SPY went down while the dollar went down here. Okay. So there's some calamity is coming. Oh my God. Aiden, thank you. I feel like I shouldn't be even on live because I can't even breathe right now. But, the show must go on. It's okay that I'm unable to breathe right now. It's okay. Show must go on. But yeah, so there's some instances in which, the SPY went down while the DXY went down as well. So it's weird. It's very curious. And so now we have the same exact thing where DXY comes down, stock market comes down. Typically, it's the inverse. So, signaling fear in the market, panic in the market. Markets doesn't know what to do. It could also be the unwinding trades, right? The Japanese trade war, not trade war, sorry. The yen carry trade, the base trade for bonds and all that stuff. So everybody is just scrambling to sell as quickly as possible in order to cover their leverage. It's called deleveraging. Okay, deleveraging. There we go. I think that's a better term for that. And so when that happened, obviously, people just running in all direction. But there's only one stock. It's only one right now where people should be paying attention to. And of course, GameStop is the one. Why GameStop? Well, okay, yes, you could buy any other company. You don't have to buy GameStop. But I'm just saying that, we've been here for quite a bit. We understand that this company is cash rich and now about to be Bitcoin rich too. How rich, we don't know. Okay. Hey, Anthony, what's up? I was looking into Vancouver Stock Exchange, Canada, found a lot of crime, okay, corruptions and mysterious death. Oh my goodness. I wouldn't be surprised at all because would not be surprised. I mean, people are just crazy sometimes and evil. They don't care. As long as they could deceive people, get what they want, and then they just left. They just left. Okay, great. I got what I need, so why do I have to stay? Okay, so yes, so the price action today is very telling. I was expecting a lot more, honestly, But because the market's kind of puking today, so of course GME is gonna puke as well, but not by much, just 1 cent it seems. You kind of see the doji candle there, and so it means there's indecisiveness that is happening, but towards the top. Okay. So what's that mean? Continuation, right? Continuation. Look at this. Boom. Okay. Kind of break the trend line there already. So we might come down a little bit tomorrow. If we are freaking out about the market, right? But I mean, again, oh my goodness, like $26. That's pretty good. Hold up there. While the SPY are not anywhere near that. Let's see. Oh, right. Look at that. Everybody is red. 3%. What's Amazon? 3%. Meta, 3%. Everybody is like, so no, I mean, Walmart is pretty good, but GB, point, like technically flatlined it. I need a better sell anyway. Of course. But I think again, like, God, like I don't know how they would be able to bring GME down during the market crash. Can you imagine if GME blips down to like $5 a share real quick? Hey, I got paid. Wait, when did I get paid? I forgot. I think is it this week? No, I think, oh, never mind. It's next week. But anyway, my point is like, any amount of dip on GME, people are going to buy it up for sure. It's not going to stay for long. That's what I'm trying to say. That dip, it's going to be bought so quickly. If it's down to 10, 5 or whatever, right? And then that's when you're like seeing the rocket that you could like dream of, right? But anyway, so if Roy Kitty were to tweet today, of course it's gonna go berserk. Yesterday he didn't tweet, so nothing wrong with that. It's just a disappointment. Of course, people want you to be hyped on the date and all that stuff. This is crazy, you guys. Look at this. But anyway, that's fine. So, Japan is about to intervene in the currency market. Okay, devaluing the yen again. The only one trick, you guys. They know only one trick. That's it. That is to print money. Okay, let's finish up this video real quick.
The conflict between the White House and the Federal Reserve, when you have the tax cuts already enacted, and we see inflation going higher, and the trade war, and the tariffs, and bond yields is skyrocketing, what do you think Trump is going to do? He's going to bark against Powell to cut rates. But because of inflation fears, Powell is not going to be able to cut rates anymore. And that's the point of collision. And that could happen really fast, by the way. I mean, next year, he's going to take over not just the White House, but the Congress, the Senate, everything. He can pass a tax bill easy. And I love this commentary again from Peter Schiff. He says big tax cuts are coming for sure. Those are the easy promises to keep. But promises to cut spending won't be kept. That means already huge budget deficits will soar. To prevent long-term interest rates from soaring, too, the Fed will return to QE, sending inflation through the roof. Well, the Fed is already doing QE even before we see the deficit soaring. And that's going to lead inflation to soar. And then the Fed will have to reverse course really, really hard. We're talking about hikes of 50 basis points plus. And the White House is not going to respond pretty good to that. Here's another one. Schiff says that Trump promised massive rate cuts, no cuts to entitlement or defense spending, lower mortgage and credit card rates, and reduce deficits and inflation. All of those promises cannot be kept. Bingo. In trying to keep some, the biggest sacrifice will be soaring debt and inflation. That's spot on. The two don't go together. Because if you're going to do the tax cuts, you're increasing inflation by increasing the deficit. Because the Fed will have to print more, they have to devalue the dollar more in order to fund the tax cuts. Okay? Now, we know that the bond...
Crazy. You guys, like, again, solution is always print more, print more, print more, print more. So, again, why do you think Bitcoin is such a good, at least learn about it, you guys, okay? If they print more, that means Bitcoin is the only way out of the system at the moment. Okay, so let's see what's going on in the dark pool real quick before I go on to the M2 money supply real quick. I know I've always kind of talked about that. So the chairman, the SEC chairman, Paul Atkins, is going to be sworn in. Well, it's already sworn in. And he have a statement about naked shorting. Essentially, he doesn't like it. He thinks that it should be penalized for firms to do that, so that they are less likely to do it. If you are shorting the stock, you have to borrow it. You have to pay for that borrow. No longer naked shorting. So, well, hopefully he's going to address that one. We don't know whether he's going to do that or not. That's up to him. But, there's a lot of, dark pools still. Look at this. Like, crazy, huh? But how are they going to contain this, you guys? I don't know. They've been distributing it pretty quickly during the bond. And then now it's creeping back up. There's no... accumulation, sorry. A lot of accumulation right there. So, but again, people, there's no dumping today. Discouraging. Okay. Because this is the last couple of hours there. Look at that. Boom. Boom. So tomorrow, can we see something spicy like that continue? I think so.
Federal Reserve come to the rescue. So I'm going to show you this 1-minute clip.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. So what I think is going on in markets is markets are processing what's going on. And, it's really the policies, particularly the trade policy. And really the question is, where's that going to come in? Where's that going to land? And we don't know that yet. And until we know that, you can't really make informed assessments that would still be highly uncertain. Once you know what the policies are, it'll still be highly uncertain what the economic effects will be. So markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation. Markets are doing what they're supposed to do. They're orderly, and they're functioning just about as you would expect them to function.
Okay, so Jay Powell, chair of the Federal Reserve, says that the Fed will not rescue the stock markets as long as the markets are functioning. And this is what I suspected before, that if there's a correction, if there's a bear market, then the Federal Reserve is not going to intervene. But if there's a stock market crash, like a collapse, then in the situation where things are not functioning, then I believe that the Federal Reserve will have no choice but to rescue the markets. I mean, again, that's my opinion, but
Yes, I agree with that too. Because they need the price to be stable. It's what they always say, price stability. Price stability. For who? For themselves. Yes, for sure. But I mean, look, for GameStop, you go, doesn't matter what's going on in the world, right? People would be like, just like this guy right here. Look at him. Look at how I love how like he shimmy his shoulders. Like, look at how. So people are just buying the dip and then holding, right? So again, nothing could stop this because we know what's happening in GameStop. As a company, we're doing well. Even as a stock itself, it's doing well compared to any other, stocks in the market right now. Everybody is red, for sure. Now, of course, people think of a new date already. I feel like, right? So that's from yesterday. Not much there, you guys. Okay. You know what? I feel like I have to go, you guys. Otherwise, I might not be able to breathe at the moment. But yeah. For sure. I don't know what's gonna happen tomorrow, but I think there's gonna be a continuation. I'm nowhere near red. Oh, good. That's good to know. I'm still red for my portfolio, but I'm okay. I'm okay for sure. Not far from that. Anyway, so if GB were to buy Bitcoin anywhere here for the past 3 weeks, we are going to be on the green for Bitcoin holding. So Bitcoin's going to continue to go higher. It's going to be the flight of safety, and people are not even buying bonds right now. So they rather have gold. They rather have some Bitcoin here. But typically, when gold price goes higher, Bitcoin follow immediately. Okay, let's look at that. Ooh. Something is happening, you guys. So all-time high. So, and then if you were to put Bitcoin on top of that, of course, have to see that correlation there. Let's do a week. Okay. Okay. So as you can see, gold go up, Bitcoin goes up after. Gold go up, Bitcoin goes up after. Okay. So that's what I'm trying to show you. Should I put like in a better? That's not good. Accurate. This is the one. There we go. It's hard to see. Yeah. Just trust me, okay? Just trust me that this is the correlation. But yeah, flight to safety for sure. People are freaking out. They don't know what's going on. But stock's gonna do worse, you guys. Except one. Of course, we know which one. So, while everybody is struggling, we're doing well. You see? Alright, guys, I cannot breathe right now, so I will let you go. Sorry about that. Hopefully, I'll get better tomorrow. If not, well, that's life. So, alright. Thank you, guys. See you when I see you. Bye bye.